I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome to the show, John.
Hey, Jim.
The U.S. dollar, of course, strong, but has fallen a bit. And, of course, the Canadian dollar has come up thanks to that mostly, I think. But what kind of a position is the U.S. dollar in right now?
Well, it's come off its highs for sure. It was the dollar index, which measures the dollar versus lots of other currencies, was above 100 for a while. And now it's down into the low 90s, which means we're approaching a 10% decline in the overall value of the dollar. And that's a pretty big deal. In part the dollar was so strong because the Fed had been threatening to raise interest rates for a really long time, and then they raised once, and now they're kind of backtracking. It doesn't look like they'll raise much more, if any, in the year ahead. And so the markets are responding to that by selling off the dollar, in part. But the really interesting and scary part of the story is that the euro and the yen are going up, which, when you say the dollar is going down, it means the other currencies are going up because we measure them against each other. And those two governments, the Japanese government and the Eurozone government, have been aggressively trying to push down the value of their currencies. They've been instituting negative interest rates and ramping up their quantitative easing programs, and et cetera, et cetera. And their goal was to weaken their currencies in order to generate some economic growth, because both of their countries are basically dead in the water economically. They're hardly growing at all, and they need to grow dramatically to stop the increase of debt to GDP. If the economy gets bigger faster than debt accumulates, then you're actually deleveraging. Well, the opposite is happening for these guys. And anyhow, their plan didn't work. They tried to weaken their currencies, and instead their currencies went up. So now they're going to start suffering all the pathologies that the U.S. has been suffering for the last couple of years. We have terrible corporate earnings here. Corporate earnings are actually falling year over year, which is really unusual outside of a recession. But they're falling because it's hard for a big company to sell stuff overseas when they've got to price their stuff in a really expensive currency. And that's what U.S. companies have had to do for the last couple of years. Well, now that burden is falling on European and Japanese companies. And so the year ahead, which was already going to be tough for those guys because they're over-indebted and they're over-regulated and their economies just don't work for a variety of demographic and structural reasons. Now they've got a strong currency on top of everything else, or a stronger currency. And so it'll be interesting to see how they handle it. My guess is they won't. Nobody, with the possible exception of a few relatively well-run small countries, and I include Canada in this, but most of the big systems out there are so over-indebted, so over-leveraged, and so badly managed that they can't handle something like a 10% increase in the value of their currency, or equities bear market, or a natural disaster. Stuff that we used to just shrug off and move past are now an existential threat because we borrowed way too much money. And that is what happens when you borrow too much money. Whether you're a family or an individual or a country, once you're over-leveraged, you can't handle even small hiccups. And that's what we're looking at, is a series of things we used to be able to shrug off, and now we can't anymore. So the question becomes, which thing is going to metastasize? Which problem will grow way beyond what it would have meant 2 decades ago and actually turn into a systemic threat? No way to know. But I'm going to go out on a limb and say the Italian banks will do it in the year ahead, because they're they're so badly run, and they've got so much bad debt on their books. And without continuous government help, they would literally all of them, go bankrupt right now. And so if they're not bailed out on a vast scale, that will happen in the next year or so, and that's going to threaten the existence of the Eurozone. And then that, in turn, if the Eurozone is threatened and starts to spin out of control, will affect the rest of the world. So 2016, second half, and 2017 will be fascinating times from the point of view of economic theory, and terrifying times from pretty much every other point of view, especially if you're a retiree trying to exist on a fixed income, or somebody with a big stock portfolio. Those are really scary situations to be in a crazy world like this.
Any chance that Japan and Europe would get out of negative interest rates?
No, that's completely impossible now. And the reason that it's impossible is that they're continuing to borrow money. And then whatever they borrow, usually they borrow short term because that's where interest rates are lowest or actually negative. Whatever they borrow has to be rolled over every year or two. So if they borrow a huge amount of money now at negative 2%, and then they raise interest rates to historically normal levels of, let's say, 5%, when they roll over that debt, suddenly their negative 2% yield, which means they were actually making money on those bonds, becomes a 5% cost. And on trillions and trillions of dollars or euros or yen, that really adds up. And so to raise interest rates now would totally blow up the budgets of all the major governments. So we can never do that. We're in a box now where interest rates can never, ever go up without setting off a gigantic financial crisis. And the longer we keep it going, in other words, the longer we keep borrowing more and more money year after year, the bigger the crisis would be if we tried to raise interest rates. So it can't happen, because if they try, the whole world will blow up. And so they're stuck on this treadmill where they've got to borrow more and more money each year, and their debt goes way up. And their interest costs don't go up in the short run because their interest rates are 0 to negative, but the ultimate liability continues to grow. And eventually that will destroy these systems. We aren't going to be able to go on as we are, so we're going to have to do a major global monetary reset at some point. And the outlines of it are, unclear at this point. There's no way to know exactly how we'll do it, and whether it'll be a chaotic unwind or, a coordinated surprise that they launch on a Sunday night. I don't know. We'll see. But something like that is coming in the not-too-distant future.
China has been, of course, trying to bail out their stock markets with something like $1 trillion worth of stimulus. What's been the cost of that, and do we know?
Well, China is such a fascinating story because, to go back just a little further, they were, obviously the developing world's big growth story over the last 20 years. And then when the 2008-2009 crisis hit, China was affected by it, as was everybody else, but they responded even more aggressively than we did in the U.S. We borrowed a ton of money here, trillions of dollars at the governmental level to get ourselves out of the Great Recession. China borrowed even more. They quintupled their total national debt in the space of 5 years. And they used the proceeds of all that borrowing to buy raw materials and to build infrastructure everywhere in their country. And that pushed the price of oil and iron ore and copper and pretty much every other raw material up, and gave us the recovery, quote unquote, that we've had for the last few years. Well, then they stopped, and their stock market crashed, and the global economy started to slow back down, and so they responded to that in the first quarter of this year by borrowing another $1 trillion. And, in 1 quarter, $1 trillion is an insane amount of money to borrow. Very few countries have ever done that in human history. And so they used that money again to build up their stockpiles of oil and iron ore and other stuff. And so the prices of those things went back up. And we started to think that maybe we were out of the woods. Maybe the commodity crash was over. But nothing is over. It's only some big country borrowed a bunch of money and bought some stuff with that borrowed money. That's all that happened. And you can't keep doing that. You can't keep borrowing $1 trillion a quarter, because pretty soon you're talking real money then. And so China cannot by physical definition, keep borrowing money like this. They just can't do it without themselves being overwhelmed by the debt. So that means we have to contend with maybe another turn down in commodities prices, and by extension in equity prices around the world. And we're starting to see that happen. The U.S. Dow Jones Industrial is down 137 points today. The Japanese and Chinese markets have absolutely tanked in the last week. Europe has been down hard lately. And so it's possible that we're heading back into another commodities-led downturn because China has stopped its stockpiling of commodities with borrowed money. And so, who knows what's going to happen in the short run, but it does feel like we're entering a period in which China's trying to pause in its borrowing again, and the global markets are reacting to it as they have the last couple of times China's tried to stop. So, interesting process. China absolutely has to be watched because they've become such a huge force in the global financial system. So, and they could be the catalyst for the next crisis because they've got a ton of non-performing loans on their banks' balance sheets, and they've got this shadow banking sector that nobody understands. All these local government agencies borrowing huge amounts of money and building airports that nobody flies in and out of because the airport wasn't needed in the first place. Stuff like that is all over the place in China, and it's really opaque. They don't break all this out and tell us item by item what everything is and how its cash flow is doing. But most observers seem to think that there is a ton of non-performing debt there that is going to default or is going to be bailed out by the government. Either way, you run some pretty huge risks of either a financial crisis in the first place or a currency crisis in the second option there. And so, wherever you look, there's a brewing crisis that really bears watching. So for somebody who wanted to pay attention to all this stuff, that's all you do all day long is just switch back and forth between the Italian banks and the big U.S. banks derivatives books and China's non-performing loans and Latin America. It goes on, and new potential crises are bubbling up faster than the old ones get solved.
And of course, with negative interest rates, banks, insurance companies, and pension funds have been hammered because they have no growth.
Yeah. The insurance industry is no longer a viable business model, or at least life insurance, because what those guys have done for their entire existence is they price their premiums on their policies at a level that if they take those premiums in and invest that money at, let's say, 8%, will allow them to pay off their obligations to policyholders when those obligations come due. Well, now, high-grade bonds are yielding, let's say, an average of 1% around the world. Okay, so the insurance companies cannot make that 8% nut, and all of a sudden they're kind of tipping into insolvency as their projected returns go down, and their projected obligations don't change. And so that's the entire industry looking at this same dynamic, and there's really nowhere for them to turn. They can buy junk bonds, which are too risky, or they can buy equities, which are way too risky, and then they can't guarantee that they're going to be able to cover their obligations out there. Or they can raise their premiums really, really dramatically in the moment, which probably means their business will dry up because there's a level at which people just won't buy life insurance anymore if it costs too much, and so that doesn't work for them either. So they're kind of screwed, but they're not alone. Money market funds can't function in a negative interest rate environment, and pension funds are basically set up as insurance funds. They work the same way as life insurance companies do, where they take in money now from future beneficiaries and then invest it at a rate that they hope will allow them to cover the obligations to future beneficiaries. And now they can't do it because interest rates are way too low to allow them to successfully generate 7-8% on a fixed income portfolio, and equities are priced at historically high levels, which means that the return going forward on, for instance, the S&P 500, if history is any guide, will probably be very low, 1 or 2% a year for the next 10 years from this price point and this relationship to corporate earnings. So there's nowhere to turn for these guys who require steady, predictable income of a certain level. And it's the same thing for retirees. If you retired based on the assumption that you generate 6 or 7% on a bank CD or a high-grade government bond fund, and now you're getting 0.2%, even eating dog food and moving in with your kids won't save you. It won't even pay your medical bills, what you're generating off your nest egg. So, I don't know what the solution is for retirees either. In the U.S., they're all going back to work. The biggest increase in employment over the last 5 years has been in the 55-year and older age group. And those are people who presumably thought they were going to retire at some point in the not-too-distant future, or were already retired and figured out that they needed to go back to work to at least make part-time money. So, yeah, it goes on. And all of it can be traced back to us borrowing way too much money to begin with, and then screwing up the financial system in order to avoid the consequences of our bad decisions in the past. We won't be able to avoid those consequences very much longer, I think.
Our government's going to try to do something like, okay, today we've just written off the debts and we'll start at zero again?
Yeah, they're going to try something like that. It might take a different form where they give us all a tax rebate or something like that, and then ask us to pay off our debts. Basically what that means is they're going to create a whole bunch of money and use it to pay down debt. Well, if I borrowed a bunch of money and I can't pay it back, and the government pays it back for me by creating a lot of new money, the money that I borrowed still exists, okay? And then the money that the government uses to pay off my debt is new and added to the money supply. So you get this massive, massive increase in the money supply when you try something like that. And presumably, supply and demand being what they are, you get a big drop in the value of the currency. So you trade a debt crisis for a currency crisis when you try something like a global debt jubilee or some piecemeal version of that. And that doesn't actually fix anything. It just shifts the focus of the crisis. Something else is going to blow up, but something is still going to blow up. And I think that's our ultimate destination, is a global currency crisis where nobody wants to hold these crappy fiat currencies anymore because governments are so obviously trying to devalue them in a systematic, ongoing, aggressive way.
Well, if you remember your old algebra classes, what happens on one side of the equation has an effect on the other side. And this would be the same thing, right?
Yes. Yeah, absolutely. When you've got an equal sign there, as you said, what happens on one side happens on the other side. And so if we increase the amount of currency in the world, we, by definition, decrease the value of each individual piece of that currency in the world. And if we do it really aggressively, if we do it with big numbers, then the percentage drop in the value of the dollar, the euro, the yen, the Canadian dollar, is going to be really dramatic and will be a behavior change agent around the world. Everybody will respond to that new reality by, get this, Jim, borrowing more money. Because think about it, if we're going to devalue the currency, what's the smartest thing in the world you can do is borrow a bunch of that currency and then pay it back later once it's been devalued. So trying to do a debt jubilee would also incent people to take on even more debt. And you might end up with more debt than you started with, but a huge increase in the money supply at the same time. These guys are in a box. They can never get out of this. They're just going to try one failed policy after another until people realize that all the policies are failing. And then that's the end of the game.
We'll have more with John Rubino right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444. more.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to West Vancouver Friday, May 6th at the K-Meek Center. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with John Rubino. John, the U.S. dollar, as we said, has had a pretty good rise over the last few years. Are we reaching a point where it's going to hit a point where it either skyrockets again or takes a big dump?
Oh, who knows? Yeah, the currency war is such a back and forth thing, but everybody's getting weaker and weaker and more impaired and more leveraged. So their battles within the currency war are getting more and more extreme and crazier. And so there's no real way to know how this goes, because will Europe and Japan accept their currencies getting stronger and stronger, or will they do something even more extreme than what they've done in the past to weaken their currencies? Will the U.S. lash out at these guys? Because we're kind of threatening to do that. We're now watching the other currency manipulators in the world like we're not guilty of all the same things they are. And so the implication is that we'll respond in some way if they try to devalue. And I don't know. These guys don't know either. That's the thing. There's no plan, Jim. There's not even a guiding philosophy anymore in global monetary policy. There's just a bunch of guys trying to get through whatever cycle they value, whether it's the corporate earnings cycle or the next election campaign or to run out their term as governors of the Federal Reserve and retire with a nice going away party and prestige, et cetera, whatever. They're just trying to get through these terms. And they're doing whatever they perceive that it takes to get from here to there. And that's it. They're just going to hand their successors the problems and let them deal with it. And it's the same thing in politics, especially in the U.S. Our business as usual political candidates basically don't have any solutions for anything. And then the outsiders that run end up having solutions that either, in the case of Donald Trump, just don't make any sense, or in the case of Bernie Sanders here in the U.S., have been tried and have failed in a vast, and so that's kind of what we're left with, is stuff that didn't work in the past, doesn't make any sense, or clearly isn't working in the present. And that's our range of political choices. So I don't know. I don't know what is going to happen in the short run with the various big currencies. I do tend to think that whatever happens benefits real assets. If the world is chaotic and your farmland is just your farmland, it makes the same amount of wheat or corn or whatever year after year, then it holds its value because those things have a fairly stable value because we can eat them, And gold and silver. If the world is spinning out of control, well, gold and silver exist in limited supply. They've been money for 3,000 years. Somebody will take that in exchange for something of real value. And so gold and silver will tend to hold up just fine. So stuff like that is going to be okay. And financial assets like government bonds and equities that depend on currencies for one reason or another, like bank stocks. Those things are going to be terrible investments when things really start to spin out of control. And the stuff that's in between is the shares of big companies that operate globally and have some kind of pricing power. The big multinationals that sell stuff that people really want will probably tend to do well in a world where currencies are being debased, but the thing they're selling holds its value. So that's the kind of portfolio you want to create, real assets and a few reasonably priced, well-run, really extensive multinationals. And that's basically it. Don't get cute and play with leverage, for instance, even if you're sure you're right, because you might not be right. And the timing of all this stuff is impossible to manage and predict. So just sit back, stack your silver and gold, enjoy the real estate that you own, and know that in 10 years this will all shake out, and you'll be basically okay because you own real stuff.
Should people be selling their real estate or holding on to it?
Well, it depends on the real estate. If it's highly leveraged in a bubble market, bail, I think that somebody who takes profits in Manhattan or San Francisco real estate will probably be reasonably glad they did, or at least not too broken up about it in the not too distant future. But somebody who buys a not too expensive but well-maintained rental property in a nice stable college town somewhere far from big cities, they'll probably do okay. So it depends on the real estate. And again, leverage is bad in this world. So don't leverage yourself to the hilt to buy anything, whether it's real estate or whether it's equities or gold and silver. Just don't do that, because you just can't know what's going to happen in the year ahead. And it's completely possible to be right on all the assets, wrong on the timing, and if you've used leverage, lose everything, just as it's starting to work out, People did that a lot with real estate back in the day. I wrote a book on the coming real estate bust in 2003, and of course the real estate bubble didn't burst until 2007. And so a lot of people used leverage to bet against the real estate market in the intervening few years, and they lost their shirts when, if they had not used leverage, if they just hung in with their, housing shorts or bets against the big banks or whatever it was they did, they would have made a ton of money in 2008, 2009. So same thing is coming, a lot of things are going to work out beautifully, but they might not work out beautifully right away, and so you don't want to make a bet on timing if that bet going wrong will wipe you out. So make sure what you own free and clear to the extent possible, and that you can wait a while to make sure all this plays out as it's going to.
John, thanks a lot for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.